There's always been an innovation economy, and JP Morgan has an entire business dedicated to helping it thrive. By bringing together founders, startups, investors, and ideas, JP Morgan's commercial bank helps empower thousands of high-growth companies that are shaping the present and the future. With tailored banking solutions and a global business network, JP Morgan helps innovators scale for today and tomorrow. Visit jpmorgan.com/startups to find out how they can help you build your future. Products and services of JP Morgan Chase & Company and its affiliates are subject to availability, eligibility, and applicable terms and policies. JP Morgan Chase Bank, N.A., member FDIC. Hey everyone, I'm Matt Burns and this is TechCrunch Live. Well, welcome to Minneapolis. Well, not really. I'm at home in Michigan, but today's episode is dedicated to the great Twin Cities in Minnesota, and I'm very excited to do this. This is a city spotlight event. So far this year, we've done similar events in Austin, Texas, and Columbus, Ohio, but Minneapolis is quickly becoming a hotbed of VC activity and startups, and we had to do this event in this city. And we have this packed agenda. There are 4 panels for today's 2-hour extended event. First up, we have a TechCrunch Live interview with Andrew Leone, co-founder and CEO of Dispatch and an early investor from Revolution Ventures and the Rise and Rest Fund, Anna Mason. This conversation should be perfect for any founder of an early stage startup. We're talking about scaling. And what's interesting here is, I'm not going to ruin Andrew's story, but Dispatch started as a last minute delivery service with a couple guys and some trucks. And now they're a multi-state operator with a SaaS offering. It's a great story. And I want to stress the difficulty in scaling from a small market and then going internet or national with it. It's a fantastic job, but Andrew did it. Next, we have a panel with 2 of Minneapolis's top investors. We have Mary Grove from Bread and Butter Fund and Justin Kaufenberg, Managing Director of Rally Ventures. If you're raising cash outside of the coasts, this is the panel for you. And you're going to hear about Minneapolis, sure, but there are tips that are applicable for every market outside the coast. You really should tune into this. And TechCrunch's Hayek Campus is hosting this panel. Then, so in about an hour from now, there's a conversation on building a company in Minneapolis with Branch's co-founder and CEO, Adif Siddiqui, and early investor Ryan Bolshar, the founder and partner at Matchstick Ventures. Adif moved Branch from San Francisco to Minneapolis and hasn't looked back. Branch is easily one of the hottest startups in the Midwest and has seen a 2,000% jump in revenue year over year. Finally, there's a pitch off. Now, this is a real pitch off and not a pitch practice like we do weekly on TechCrunch Live. The companies will have 4 minutes to present their companies, and there's prizes. The winner will get exhibition space and get free tickets to TechCrunch Disrupt in October. I hope you can stick around for that. It's going to be a great time. And these are all local Minneapolis startups, and we enlisted the help of outside venture capitalists, so there's no conflicts of interest. Well, with that said, I think I have everything off the agenda here, and we need to jump into this conversation that we have with Dispatch and Rise to the Rest. Andrew, are you there?
I am.
All right, Anna?
I'm here. Let's do it.
Yeah, this is great. So Minneapolis. Andrew, you're from here. You have a company there.
Yeah.
What's special about Minneapolis?
Minneapolis has, I think, an excellent work ethic, a lot of just grit here in the Twin Cities. It makes it a great place, I think, for VCs to look to invest, because it's flyover country, right? I mean, it's the middle of the country, but there's a lot of Fortune 500 companies here, right? There's a lot of GDP, in Minnesota. So real businesses are being built. It's pretty exciting.
I think one of the most interesting statistics I read in researching this is Minneapolis has a claim of fame of having the ability to have companies survive. They have the highest or the longest length of any company. So a company's average age is over 5 years, which is really special, especially in startups when startups will be a flash in the pan. In Minneapolis, they seem to have a chance. Anna, what's your take on Minneapolis?
Well, that doesn't surprise me at all. Just reflecting on the grit and tenacity, not only of Andrew and his co-founder and the broader Dispatch team, but so much of the interaction that we've had with the startup community across the Minneapolis, St. Paul region. It's great to hear about the other investors and great friends and well-respected folks in that community who are joining this session later today. I think in addition to everything that Andrew noted, I would also point out that Minneapolis is one of the cities in the region rising economies that also, I think, enjoys a lot of support from state and local government, that also has a great university system and a really robust startup ecosystem, a startup support ecosystem that taken together really links arms and lifts up the startup community in really, really strategic ways. And the proof is in the pudding, in terms of some of the stats you cited and others.
Yeah, absolutely. Well, Andrew, let's get back to Dispatch. Tell me about your company. Where did it come from, and where are you guys at right now?
Yeah, it's a great question. So I guess it starts with what Dispatch does. We simplify final mile delivery. So we're taking enterprise B2B businesses, using software to optimize that delivery and then passing on to independent drivers. And this all started, I guess, from a real world business problem. So I've been self-employed for a while. I have a couple of business partners. We've built numerous businesses together, and we had an HVAC distribution company, and saw a big shift in that space where it used to be very route driven, call it milk truck runs, where you do deliveries around town, Monday, Wednesday, Friday, other side of town. That shifted with a couple of major things happening. One, just people valuing their time more, big premium on time, rising on-demand economy. With the space I sold into was, the trades, skilled labor, and a lot less people went to trade school, more went to university. So there's a labor gap there, right? So you had this opportunity cost, labor cost problem, and started seeing customers say, hey, can you just figure out how to get me product to where I'm doing the work, so I'm not, sending this highly talented, skilled labor around town picking up product. And our company responded to that need, started running trucks. Wasn't super scalable because you're buying, truck after truck and hiring people. And so we shifted to outsource. Outsource was great from a variable cost model. We started using couriers, but it lacked a lot of transparency and accountability as far as the customer experience. So we actually built Dispatch initially as an internal tool. It was designed to scale our final mile operation, and we soon realized after implementing this that everybody else had the same problem set. So my co-founder Ryan and I went full steam to go build a new company.
So you started with a couple trucks, and where are you now?
Yeah, so it's been a major effort of scale, right? As you kind of mentioned earlier, we started in Minneapolis. We're now in around 60 markets across the U.S. So it's been a lot of work building that playbook, and executing on that. But we'll be in 75 markets by the end of the year.
And Anna, I think when we talked the other day, you said that when you invested, Dispatch was in 4 or 5 different markets, right? What do you think was the key to expanding past that?
So what we loved about Dispatch in the early days that really inspired the initial investment and continued us to double and triple down throughout the growth and evolution of the business were a couple key things. First, I'd point to the fact that, as you just heard from Andrew, and I think this is critical to the success that the company had in very cost effectively scaling to new markets. Andrew was first and foremost his own first customer, truly building technology to solve a problem that he had as an operator in that business. And so that very deep domain expertise that he then brought in partnership with a very sales focused and sales savvy co-founder really enabled them to in a very capital efficient way, sort of lock in on great product market fit in their first market. And pretty quickly, I think through some strong customer connections that had some network effects that pulled them into some new markets, which is something else that from an investor perspective, we often look for from marketplace businesses. So you had that sort of core industry domain expertise, something we love at Rise the Rest and often look for, those network effects of seeing customers sort of pull the business into new markets. And then from there, and I hope Andrew has the opportunity to talk about this a little bit later, I think that the leadership in the team was incredibly nimble in terms of how they evolved the strategy of expanding to new markets. What worked in growing from 1 to 4 wasn't necessarily the model that then worked from 4 to 15 and then 15 to 50 and as Andrew mentioned, soon to be 75 markets.
Well, let's talk about it right now, because that core leadership team is critical when you're expanding. Andrew, what do you think was the secret sauce there with your team?
Yeah, I mean, being nimble and being very focused. We build OKRs every quarter, right? 90-day objectives, and then we iterate, on that when things come up. As I mentioned, I think we're on it's our 5th or 6th iteration of our go-to-market plan and playbook. I mean, because as you scale, you have new opportunities and new challenges, so you have to be able to adapt to those. I think what was really helpful, from the beginning is my co-founder came in with a big breadth of SaaS sales experience as they expanded his prior company across the United States. So we took that playbook, figured out the marketplace side, how to balance supply and demand, and then just iterated on that over time.
Yeah, well, let's take it back. I want to talk about the first expansion. So you're in Minneapolis. Where did you go next?
Yeah, so we had a series like 5 market expansions. It was Kansas City, Cincinnati, Dallas, Chicago, and Orlando. That was our first kind of big wave. And then we continued to step that up after they were doing larger amounts of markets at a time. But that's where we started.
Well, what advice would you have for other founders when you're looking at your second and third market expansion?
Yeah, so I mean, I'd say a couple things. We were really fortunate that my co-founder Ryan had some really good, contacts that were looking kind of at the stage of their career. They're looking for something new. So we had some, people that we were able to hire and bring onto the team that we had a high level of trust in right away. So we initially started boots on the ground, as I mentioned, that has shifted and changed over time. But early on, we wanted to make sure we were really close to the customer. So we had really trusted people in market. We've also had anchor customers. That was a big key thing. So we looked for who can be a linchpin or who can, help ensure that this is successful, and how do we rally around, those customers in those new markets. Those were kind of, say, like 2 really key things that made us successful.
How long do you think that you were this gritty boots on the ground type company before you switched over to a different model?
So we're still really gritty, but boots on the ground, I'd say a few years. And that did change. It kind of got less and less, number of people, had a bigger, area of coverage. We're mostly, I'd say, fully, virtual now. So when we launch markets, it's all done with no boots on the ground, from, a more streamlined sales approach. But it is different. We're selling to an enterprise customer base. We have a much larger breadth of coverage, not just, pockets of markets here and there. So we can really serve that national account at this point.
Yeah, I think that's everyone's goal when they're starting a startup is to be able to move into different markets with just a flip of a switch, right? But I just want to drive into this that's not how it works in the first couple of markets, right? So Anna, over to you. What advice would you give to entrepreneurs when they're looking at different markets?
I think really honing in on what network connections you have in those markets. Andrew referenced some of that, but I think another layer beneath that is that, to your point, Matt, like the switch flipping doesn't happen overnight. It doesn't happen oftentimes in the earliest stages. And in particular, I think with marketplace businesses, it's oftentimes doing a lot of that boots on the ground work that actually can't necessarily be replicated through technology or scaled. And so I do think that when you go from your hometown market, where oftentimes you may even be quite literally the hometown hero for your industry, a lot of people know you, things like that, you go into some of these next markets with a little bit more anonymity. So you can offset some of that, obviously, through some primary, secondary connections, but then it's also really a lot of that non-replicable work that helps. I think this is the important part, that helps to establish the brand presence and what your brand reputation will be in the space and in that market. And that's where I think it is a lot of hand-to-hand combat in those earliest days of really, really developing and honing those customer relationships, and then figuring out how you layer in technology and more streamlined process on top of that starts to build those next level building blocks for growth.
Yeah. Now, Andrew brought along his pitch deck. Is it Series A or seed deck?
I think it was our seed deck. There's some archiving problems. I gotta figure out what exactly which one it is.
Well, yeah. let's bring that up, because there's a timeline here we can talk through. Or let's talk about this slide right here. This was from your seed deck.
Yeah.
And this really illustrates the grittiness that you had at the beginning.
Yeah. So this is, just our market one, right? Minneapolis. This is call it our MVP of our project. And Anna, you kind of mentioned this too. You don't have to have it all figured out, right? To move forward. I think we're big on, I'll call it the Wizard of Oz method, right? Where it can look like it's tech and it's you're doing processes and figuring that out before you make the huge investment to go build a streamlined technology process, right? You don't have to have, the whole thing completely ironed out. It's more important for action and figuring out what works. So that's what we did in Minneapolis. And frankly, we're still doing that today, where you want to make sure you justify that it's a big investment to build software, right? For scale. So you want to make sure you're putting in, that energy in the right effort. So yeah, started in Minneapolis. We had Ryan and I did hundreds of deliveries, right? Did a ton of it, right? You have to know what the problem set is, and you start to realize, from a driver's perspective, this isn't great, or from a customer's perspective, this could be improved. And so, being close to it was really important early on.
Yeah, let's take a look at the next one.
Yeah, so this slide's kind of fun looking back at it. This is our what we've been doing over time. So showing building kind of the MVP at the second half of 2016, and then from launching different markets, adding things to the product that I think seem really, really simple, but were big deals at the time, like geofencing, and then hitting our 10,000 delivery milestone. That was a crazy deal. We calculated the mileage in our first year, and it was enough to go around the moon and back. And as a little startup, we were focused on day one of generating value to our customer. We have a value called speed to value. It's this bias towards action, but not forsaking value. And so we were even doing, I think we had roughly 3,000 deliveries done with paying customers on our staging server when we first started.
Think back to when you were pitching this to local investors. What did they say?
Yeah, I mean, I can tell you, VC at first didn't believe we had a big TAM. It's now I think we talk about final mile logistics, and everyone is, it's like front and center of the news. Back then, about 5.5 years ago, it was a lot of questions around, is this really a big market? And as operators, we're like, are you kidding me? Like, we're living this; it's massive. But you have a little bit of that disconnect, because our space particularly is a very old school wholesale distribution space, is where we focus, and it's just not as familiar, right? Versus like a consumer space.
So this deck was obviously 2017-ish, early 2018. Yeah. At that time, did you foresee yourself expanding out into these different markets?
Yeah, our plan was to absolutely do that. I think the big flag or indication that we need to do it faster is our customer pull. So we're selling to localized locations, but they're part of national brands or regional brands, and so you do a good job and they want you to expand. So we had a big pull. We actually raised a fair amount of money from our customer base, believe it or not, before we got VC, because customers said, hey, what do you need to do to get to Cincinnati? And like, money, And so finally it was, you realize a lot of these customers we were selling to were LPs and funds, and they had good, healthy businesses. And they're like, well, yeah, we're spending money on this already. This is a no-brainer. So we had some investment from our customers early on, which really helped get things going.
Well, I'm hoping to dissect this slide a little bit. Anna, can you take a look at it for me? And as an investor, what does this say to you?
So a lot of what I see here, and this is what I'm pretty sure actually this was also the deck that Andrew used to pitch us, because we first invested in early 2018, I think, when this round was together. So it looks a little familiar. For us, I think what we're seeing here is first and foremost, like, early indications of product market fit. Inside of a year, you go from, 0 to, first hires to 10,000 deliveries. That really tells us that, the team, at a very molecular level is really onto something. And then importantly, I think you also start to see, technology growth and improvement, like, layered into the business. And so a lot of what, we were trying to figure out, to Andrew's point around the VC age-old question around TAM and how big could this be, from a Rise the Rest perspective, we're always focused on opportunities between the coasts. We're very loud and proud about it. And by extension, that has naturally taken us to a lot of marketplace businesses because we love cities. So we love businesses whose business model is to quite literally grow through city-based expansion. But we also actually really not only love B2B opportunities, but we also have historically really seen the value in that. To Andrew's earlier point around GDP, we talk a lot about the fact that in venture, 75 to 80% of venture capital goes to 3 states and the coasts. What's interesting to me is that 75 to 80% of the Fortune 500 is located everywhere else. So I think we certainly got the joke on TAM being really large here. And while there was a lot of money pouring into marketplace businesses in the consumer side of things, and perhaps largely in coastal headquartered startups, we saw a similar opportunity in very unsexy B2B businesses like HVAC and electrical supply that just hadn't gotten the focus from a tech-enabled startup standpoint in this type of marketplace business. So seeing that early connectivity is a lot of what came together for me, not just in this slide, but in the deck more broadly.
So, Andrew, if you were to extend this timeline out to 2022 right now, how many deliveries would you have?
Oh gosh, I mean, it's a lot. I have to pull the stat. I mean, we do that, tens of thousands a month, right? I mean, it's
so multiple commas, right?
Yeah, it's fun when you hit those milestones where you're like, oh, that took us like months to do, and we did it in a day. Kind of milestones, right? Those are always really fun. But I mean, as you expand, you get the velocity of volume. We've also, our products have adapted a lot too. How we look at deliveries has changed from the early days. We did one thing, we did really well, but it was like point A to point B, ASAP. And now we have, multi-stop, and we're maximizing cargo space on vehicles through our software to, aggregate more parcels on the vehicles. There's a lot more we're doing now that's far more sophisticated than what we were doing back then. But back then it was all about, traction and doing one thing incredibly well.
When did you know, or when did you see the signal that you had to switch to a SaaS model?
Yeah, honestly, more recently, the last, call it year and a half, we started seeing, we started creating problems for our customers, actually. So what happened is we provide a very, tech-enabled experience that had full transparency, accountability. Deliveries were done in sub an hour that normally took a day. And that changed like the customer experience, right? So the end recipient loved it, and then didn't want to go back to in-house vehicle fleets doing delivery. And most of our customers had significant investment there. And you can't just turn off leases on vehicles overnight. You usually just don't lay everybody off overnight. And so our customers actually reached out asking to use our tech internally. And so we saw that trend enough that we did a lot of that pre-work, making sure that they're willing to pay for it, which is super important, right? And then and then built a product that connects an internal fleet with our outsourced marketplace. So that's a relatively new. It's about a year into being live through our beta, but it's super exciting. So that layers in on top of everything else we do.
Yeah, and now you two seem to work great together. I've enjoyed the conversations the three of us have had. What happens when there's conflicts between you two, though?
Between us?
Yeah.
Boxing gloves,
No. Oh, you want to take it first, Andrew?
No, I mean, I think we, I actually personally like healthy conflict, because then, you're being challenged. So I don't think there's anything that's ever been, insurmountable. I think I really enjoy talking to Anna. We love conversation, like working through ideas and getting different feedback. And you realize, you don't know everything, right? Especially in doing a venture-backed company. Anna and the rest of the Rise team have been fantastic for Ryan and I, for just educating us on a space we're unfamiliar with, right? We've been operators, right? Growing businesses before, but raising money and things to look out for and positioning, all that was new. It's a new skill set you had to learn. And so, Anna and the team have been great helping us there along the way. And they were in early, so we got, I feel like, the best of the best right away, which has helped. Yeah.
Yeah. Best of the Rise of the Rest. So Anna, take me through the Rise of the Rest fund. What's a good founder fit for your investments?
Sure. We're currently investing out of our second $150 million fund. And a sweet spot for us for entry point is to write a $500,000 to $1 million check into a seed round for a company that's raising anywhere from call it $2 million up to maybe $5 or $6 million. We've historically liked to stay inside of 20 million on a post-money valuation. That's obviously fluctuated depending on the market cycle that we're in, but we're pretty good at staying within those goalposts. We do invest broadly across a pretty wide range of industries, and so we love, from a business model standpoint. We really focus on all of it, from marketplaces we've obviously talked a lot about today to B2B SaaS, consumer. We don't really do anything in the medical device space. We don't do anything in the cannabis space, and we tend to do very little in the CPG space. But other than that, hit us up.
Yeah. Now, Andrew, when you were raising cash for this, did you have to go to the coast to raise anything, or could you do it from local investors?
Yeah, so we had angel investors locally, which is great. There's a couple different angel investor funds, and we did reach out. We went to Chicago, it's kind of a Midwest area, to raise money. It's been incredible to see a lot of these funds that didn't exist when we started emerge, yes. And they're making significant investments. It's great for the ecosystem, right? I fully plan to recycle my money, back into that same ecosystem someday. So it's definitely evolved, but no, we were able to, I think, Anna, we met through Great North Capital. So Great North Venture Fund in Minnesota, was our first, investment from a VC standpoint, and introduced us, and, the rest is history.
Is that a normal chain of actions, Anna, that you get introduced from a local VC? Because you guys are based out of Virginia area, right?
We're based out of the DC area, so Rise of the Rest is led by our chairman and CEO, Steve Case, who's also well known as the co-founder and CEO of AOL, which launched and scaled obviously in our own backyard in Northern Virginia. And for us, it actually, we've invested, we've probably co-invested with somewhere between 350 and 400 VCs at this point, and I'm grateful and delighted that it's a really healthy mix of a lot of regional VCs, industry-specific funds, and also, and we think this is great for the thesis, increasingly coastal funds as well. We actually had a report that came out at the end of last year, literally called Beyond Silicon Valley, that tracked the outflows of early stage seed and Series A capital out of the Valley and New York to a certain extent across the rest of the country, but have always been really grateful to the Weber brothers and Great North Labs, now Great North Capital, for that introduction. And we oftentimes see that. We actually host annual investor summits where we try to bring together investors from all 50 states so that we can really exchange ideas and insights, not just about what's happening in venture, but importantly, great deal flow and co-investment opportunities.
Andrew, I'm going to give you some time to promote Minneapolis here. What do you see as one of the strengths of the region?
Yeah, I think there's a great collective of founders. I mean, I think there's a lot of pay it back mentality in Minnesota. Like Ryan and I, we try as much as we can to we don't always know what to do, but we know what don't do this was not a good idea, so we can at least pass on that advice. There's some great conferences and things that go on in the cities, and so also again there's real business. I would invest in Minnesota because it's like I went back to before, grit, right? A lot of these,
sure.
It has been harder to raise money, right? So you have to have a better business, I think, oftentimes. And so that's not a bad thing, right? I mean, that's great for everybody. It's great for investors. It's great for, building real companies that have, genuine traction. So there's a lot going for it. And I again, more money being available in these regions, that definitely helps. I think that I think Rise of the Rust was leading the charge in many ways. And you're starting to see a shift in mentality of, hey, there's great businesses that can provide our funds great returns. And so you see more and more capital going into cities like Minneapolis, which is great.
You talked earlier about sales in the area, and that's something that Justin Koffenberg, who's on the next panel, will talk about as well too. But he was telling me that there's a huge sales community, and if you're to build a sales team, you need to do it in Minneapolis. Why do you think that is?
Yeah, that's a great question. I think the sales teams in Minnesota in the Twin Cities have had to learn how to sell, everywhere, right? First of all, I mean, they're selling to, all coasts, they're selling to the Midwest. Go back to just having to, work and grind it out. My co-founder, again, came from Koffenberg's actually previous company, Sport Engine. So he was there through, during that high growth days, and, got to see how they iterated on their sales playbook, and got to take all that learning here. That's another great example of like ecosystem building, right? Is that, Ryan took all that knowledge, and now, we've built this awesome company together, right? And hopefully the idea is that we're helping, the rest of our team build that skill set that we didn't have, and I really hope that they start, great companies as well, from what they've learned at Dispatch. And so it just, rinsing and repeating, putting that talent, money like back into the ecosystem is fantastic.
Well, to get that money back into the ecosystem, you have to have an exit. How do you see that happening?
Yeah. Jury's still out with that. We'll see. I mean, I think we have a lot of different angles. I mean, our main focus right now is doing what we've been doing, right? Just building a solid company. I feel like if you build a great company, you got every option in the world, right? You can, hey, guess what? You can actually make money. That's an option too, right? You get to the point where you start being profitable, right? And pulling money in. You can do that. You can sell to a strategic, go public. So that's been our focus, is just let's build a forever company and stay focused on that. And then we'll have, hopefully a lot of doors open up.
How many markets are you in now? You're in 60?
Yeah, around 60. Changes rapidly because we're on an expansion plan, but yeah.
Well, we have a video for that. And while we play that, let's talk us through. You started in Minneapolis.
Yeah, we started in Minneapolis and raised some seed capital. Thank you, Anna, to go expand to 5 additional markets. So you can see this there. Every second is about a month in our history. This goes right into about 2020. Is when this video ends. But you can see as we raised then our next round of capital, expanded another 20 markets, and continue to execute on our playbook, iterate on that. You start to see the natural like network effects happening around the country, and then since where this video is ended, we've raised more capital and continue to do.
Is it getting easier? Is it getting easier to launch new markets?
Yeah, I'd say yes. I mean, it's easier. It's different though, right? New challenges. We actually just completely change some of our go-to-market teams in playbook for a new wave of scale, right? So it's gotten easier from certain aspects and more challenging as well. But you definitely, when you get from a marketplace business, the network effects help, right? It's easier when you have a big customer list to expand to an additional market because you have more relationships to tap into. So I'd say like certain components of it definitely get easier.
We're almost out of time here, but I want to dive into one more point. You said several times that you changed your playbook 4 or 5 times, your go-to-market strategy. When do you know to change that?
It's kind of, it's like a hitting the ceiling. Your growth maybe slows a little bit, or you start having more challenges than you used to. So, we've seen that time again. It's now it starts to feel like a very natural feeling. You're like, okay, something's off, something needs to change, right? And it couldn't be a gut thing, but a lot, now it's much more data driven, at the stage of company we're at, where we start to see metrics change. Originally we opened markets with some owned lease vehicles, to guarantee, quality control. That doesn't scale well, but it's great to build a brand early. We've transitioned from that to different methods of expansion. But it's something that we keep working on with the method we have until we start to see that diminishing return or that change. And then back to the drawing board.
Yeah, no, Anna, same question to you though. How do you help these companies scale?
Yeah, I would add 2 points to what Andrew said. I think the first, and well deservedly so, I think a lot of our conversation over the last half an hour or so has really revolved around top line growth. And I think behind the scenes, and this is maybe where a lot of boardroom discussions and fun came into play for your earlier question. As the business grows and evolves and matures, you also really have to start thinking about different aspects of profitability and the margin profile of the business overall, and also on a market level basis. And so that can also drive some of the evolution and growth of strategy. And 2, I also think that as a business like this finds a certain sort of initial point of maturation and impressive growth, then you also start to see the introduction of that new business model. And it's not just the opportunity to grow from a GMV based business to also introducing a SaaS based revenue component. But I think what you really also see there, and Andrew alluded to this earlier, is that the needs of the customers also evolve. And what's exciting about that is you have a business, and this is where the TAM, I think, really unlocks. You have a business that goes from capturing just really maybe like the long tail of customer demand to really more of like the belly of that curve. And so that then can start to inform different strategic conversations about leveraging route density and then vehicle, utilization and things like that. So I think it just gets more complicated is probably the non-long-winded answer. And just trying to be, I think from an investor standpoint, good partners to the operators who are really doing the hard work and like boots on the ground of building and scaling a business. You want to be a sounding board, and you want to try to introduce perspectives that founders may not always have the benefit of seeing because they are so in it. And so we're just there for that all day long.
Oh, this has been great. Yeah. So thank you so much for doing this. And we have a lot more Minneapolis content coming up. But before you guys go, I need to ask Andrew, where's the best place to eat around you?
I love Pimento. It's this little like Jamaican jerk place. Ryan and I, like in the early days, it was like where we ended, picking up deliveries. And I think it's fantastic. It's like this little place.
Pimento.
Yeah, Pimento. Yeah, it's great.
All right. Very good. Well, thank you so much for joining us, you two. It's been a pleasure. And coming up next, we have an interview. Hold on, I'm lost on all my sheets here. Yeah, there we go. We have an interview with Mary Grove. She's the managing partner at Bread and Butter Funding, Justin Kaufenberg, who is a local founder turned investor. So stay tuned for that. And I'll see you guys in about an hour with the Pick Shop. Thank you so much.
Thanks.
Hello and welcome to our TechCrunch City Spotlight Minneapolis. I'm joined here today with two wonderful VCs from Minneapolis, and we're going to be looking at what it's like to invest out of one of our hub cities out in the world. Let's get started. Would you like to introduce yourselves and quickly tell me about what you invest in?
Sure. Mary, would you like to start?
Sure. Well, thank you so much, Haya, for having us today. Thanks everyone for tuning in. So delighted that Minneapolis is in the spotlight for so many good reasons. My name is Mary Grove. I'm managing partner at Bread and Butter Ventures. We're based here in Minneapolis. We're a seed stage firm investing all across the country in what we define as the bread and butter sectors, if you will, of the modern economy. So specifically focusing in three areas: food tech, digital health, and enterprise SaaS. Roughly mapping to thinking about how we feed ourselves, how we care for one another, and what the future of work looks like. So seed stage to us means early stage companies should have a live working, at least MVP of the product in market. A little bit of utilization and engagement data is fabulous. We do invest pre-revenue. We are investing right now out of our third fund. We have a total of 60 companies in the portfolio. And while we're based in Minnesota, we invest, as I mentioned, all across the country. So about 25% of our investments are based here in the state, about 40% are based in the Midwest, and the rest are pretty well distributed. But what makes me most excited about, our thesis is really leveraging what we consider this Minnesota home field advantage relevant to today's conversation. But I would argue that in particular in the sectors that we're looking at, there really is no better backbone and home base than Minnesota. We are home to the highest number of Fortune 500 companies per capita in the nation, especially strong in these sectors. We can get much more into that, but our thesis is very much about leveraging where we are based to support companies after we invest. And then just quickly, my background is in tech and early stage investing. So I began my career with 15 years at Google, worked on the IPO deal team, did early stage product, new business development. And then I started the Google for Startups organization there in my last 6 years. So bring that perspective, and was also an investment partner at Revolution on the Rise the Rest seed fund, and thrilled to be with you today.
Awesome. Thank you so much. Justin?
Yeah, thanks. Justin Koffenberg, general partner at Rally Ventures. Quick personal background is I started a company called Sports Engine, a company that we started in our University of Wisconsin-Eau Claire dorm room. Ultimately grew that from zero to well over $100 million in ARR. Ultimately sold the company to Comcast and their NBC Sports division. Stayed on as CEO and co-founder for about 3 years. Stepped down in 2019 and joined Rally Ventures. Rally had led my Series A and Series B a number of years ago, and I was just blown away by the type of investment partner they were, and I wanted to be the type of investor to other entrepreneurs that they were to me. So I was very inspired when I joined. Rally Ventures, right now we're investing out of a $250 million fund, number 4. The firm has about $600 million under management across the first 4 funds. We've got about 70 companies that have been invested in thus far, about 50 of those or so that are active in the portfolio right now. We're typically writing anywhere from a $2 million to $10 million first check, so a fairly concentrated portfolio for a seed and Series A fund. We're about 40% seed, about 40% Series A, and about 20%, what I'd call kind of special situation, Series B, et cetera. And we're pretty close to equal 1/3, 1/3, 1/3 focus on cybersecurity, what we'd call SaaS plus, and then what we generally refer to as core business solutions, and heavy focus on, I would say, future of work within that category. So I'd say generally a little bit later than Mary is. Our seed investments are typically fair amount of revenue, fair amount of traction, fair amount of customers in market. So a little bit later on the seed side on the average, then quite a bit of kind of what you'd consider traditional Series A. We're about 40% kind of Silicon Valley in terms of number of companies in the portfolio right now, about 30% Midwest and about 30% East Coast. And the Rally team, we're just about half of us in the Minneapolis office and about half of us in the Menlo Park office.
Awesome. Thank you. That was a really solid introduction from both of you. I am intrigued, right? There's this common kind of belief that if you want to go anywhere, you have to go to New York or Silicon Valley. And more we're realizing, and especially in a world where everybody's working remote, that just isn't true. And I'd love to hear more about what are you most excited about right now about your local ecosystem and why that's a strength and not a hindrance. Mary, do you want to take that one first?
Sure. And I'll share the caveat that with the exception of the last 4 years, I've spent the entirety of my career working in Silicon Valley and New York specifically. And in addition with Google for Startups, was working in over 100 countries from an entrepreneur perspective. And so taking that lens and then applying it to the opportunity in the Midwest broadly, in Minnesota specifically, it's become just an absolute obsession with the opportunity that exists here, right? And it's so many reasons, really. One is the diversity of the economy, right? We talk about the variety of sectors here that are super strong. We happen to be focused on the 3: food tech, digital health, and enterprise SaaS. But if you look at the titans of industry, we have Ecolab, Cargill, General Mills, Schwann's, Mayo Clinic, United Healthcare, Target, 3M, Securian, US Bank. I could go on and on. Minnesota is a headquarters economy, right? We have 57 companies based here who do north of $1 billion in annual revenue. So the opportunity for those titans of industry to flow and work with the emerging tech startups in these verticals is a tremendous, in my mind, untapped opportunity that we're just beginning to scratch the surface of. So that's super exciting.
Yeah.
2 is that it's an excellent.
See money and talent flowing back and forth between those big companies as well.
Absolutely. From the perspective of, those corporations, opportunity to invest in venture funds, to make direct investments into startups, to strike commercial partnerships, to potentially acquire companies in those verticals, right? And create this continuous flywheel between the emerging and the fully developed. And so that's a major advantage that I believe we have here. Another one is in terms of the actual labor market, right? This is a very much more comparatively capital efficient place to build and scale a business. Also to build and raise a family, right? You'll hear a lot of Minnesotans talk about this is the absolute best place to raise a family. And I moved here, I had 1-year-old twins who just started kindergarten a few days ago. So living that journey myself, but a couple of interesting stats there. We in Minnesota have reported the last 2 months, the lowest unemployment rate ever reported by any state ever. at 1.8%. We've got the highest level of 5-year survival rate for new starts, meaning companies who start if they're still up and running 5 years later. And we have the second highest labor force participation rate for women anywhere in the country. So if you think about building an inclusive economy, an inclusive future in an affordable way with a high quality of life, I'm living testament. But I do think that there's, having come from the coast, just a lot of opportunity here that is really untapped. So I'm super, super excited to continue building, from this vantage point.
Yeah. Justin, do you want to tackle the same question? What are the advantages of the local ecosystem?
Yeah, I think similar to Mary's comments, I do think quite a bit of stock should be put into the actual kind of, human capital here in Minnesota. That's a big deal to us. When we talk to prospective investments that are based in Minnesota, we spend a lot of time talking about how they're actually going to take advantage of the local labor market. And I would say even just recently, when we spend time talking to investments on either coast, more often than not, we're actually talking to them about doing things like considering opening a sales hub or a second office in Minneapolis to take advantage of it. So we feel that strongly about kind of the attractiveness of the labor market. A few things that we've noticed. I would say that in terms of actual sales talent, call it inside sales, software as a service, kind of dyed in the wool, go to market talent. That's an area where we found Minneapolis to kind of be without compare, and there's strong, people in, obviously marketing and engineering and product and other functions too. But we've just particularly found that in the kind of traditional modern SaaS inside sales motion, Minneapolis punches way above its weight. So we've actually got a number of companies on both coasts who have effectively decided to build their entire go-to-market and sales organization based in Minneapolis. I know in my own prior company, when we had more than 100 quota-carrying sellers, on our team, most of whom were based in Minneapolis. And just that little microcosm, a view into it, of those 100 plus people, a huge volume of them have now gone on to become inside sales managers, inside sales directors, VPs, CROs. So that is, I think, a particularly attractive part of the local labor market, in addition to all the things that Mary mentioned. The one other thing I'll say from a recruiting perspective, which is a big part of why we like building in Minnesota, is I do think there's a lot to the idea of being a big fish in a small pond. And while Minneapolis is in and of itself not a small pond, it's a major city, relatively speaking, an exceptional company can get a disproportionate amount of attention here. And it's much easier to get your fair share of press, to have, incredible kind of visibility with prospective employees, and frankly, to just get almost more than you deserve in terms of visibility within a given market, which leads to just really, really successful recruiting patterns and hiring patterns. So yeah, I think a lot of it does have to do with the people.
I think it's a great point, Justin. And one data point that'll underscore that, we just committed to lead the seed round of a Minneapolis-based startup. And right now, all the discussion is around talent and where do you hire and do you go fully remote? Do you do a distributed team? And this company has chosen, they really want to build, they're currently all in Minneapolis and they want to build, that's the plan. And I didn't really flinch when they said that because I am confident, right? And this is a health tech company. I am confident that they're going to be able to execute on that vision based on the talent pool that I know here. And that's not the case everywhere. So it is really well put.
So where is that kind of myth coming from then, that you have to be in New York or the Bay Area? I feel like every time we do one of these city spotlights, and of course that's why we do them, right? Every time we do one of these, I'm like, wow, there is a lot to be said for, well, A, not paying Bay Area wages, but also getting a lot of really solid local talent that have cut their teeth at big corporations and that know how these kind of dynamics work within the. Do you have any thoughts on that?
Yeah, I'll just maybe mention a couple of thoughts. I do think that for some period of time, the myth wasn't a myth. I think there was some truth to it, frankly. When we were starting our company, we were encouraged by a number of our VC investors to, move the business to Silicon Valley. We pushed back against that and couldn't be more glad that we did, of course. And as I mentioned, my main investor, Rally Ventures, was supportive of us staying in Minneapolis. But at the time, some of the rationale actually was somewhat sound. We did have a real gap, I would say, in like product management talent in Minneapolis. We had a lot of good technologists, very few people who had owned a product and scaled it to millions of users, and millions or tens of millions or hundreds of millions of dollars in ARR. There was a relatively limited number of people who had done that. I would say in the marketing practice also, there were a relatively small number of CMOs who had built, what you'd consider like, modern, marketing stacks, modern marketing tech stacks, modern, product-led growth initiatives, things like that. And in a lot of cases, ourselves included, and a number of our other portfolio companies did have to go outside of Minneapolis to find some of that talent. Now it's become just totally democratized. There's this movement of labor which allows people to easily move to Minneapolis or to commute to Minneapolis or to be remotely part of the team. And there's just like a huge democratization of information. I mean, frankly, TechCrunch, for example, a decade ago, there were a limited number of places where you could actually read about best practices of startups coast to coast. Now that information is at your fingertips. So I just think the talent here has now been enabled, and a lot of the gaps that weren't a myth, they were actually true, have filled in.
I would say that, a lot of it ultimately boils down to density as the origin story of why these hubs. Density is important, right? Density of talent, density of investment capital, density, physical density of running into other companies, mentors, advisors, the energy that we feel so often in, whether it's University Avenue or the Mission or Soma, that is, there's real value in that. And I can't underscore how important that is. But historically, that then created the institutional structure of, right, for a long time now, 75% of venture capital funding has gone to 3 places, right? Silicon Valley, New York, and Boston. And that sort of perpetuated that, whether you would argue that it's a myth or not. I mean, I would argue that it's a little bit of a tail wagging the dog there on, is it the chicken or the egg? But I think that one of the benefits, the silver linings that we've seen emerge in the last couple of years, right, with the COVID pandemic, has been the shift in willingness on the front of VC investors, forced really to begin making investment decisions remotely, begin looking outside of just their geographic radius. And yes, a little bit of that was beginning to happen even before the pandemic, but it truly normalized in ways that I really don't believe that we'll ever completely revert back to anything related to how we build companies, how we invest in them, how we help manage the portfolio. And it's just it is a new way, a new era for venture. And it's super, super exciting. So some of it is historical, and some of it is really just the tailwinds are here now to democratize access to capital.
Yeah. May I ask what your personal reason was? I feel like you could have gone anywhere in the world. Why Minneapolis for you?
For me? Yes. I mean, many a good Minnesotan by marriage, I moved here for a couple of reasons. One was both professional and personal, but personally, I come from a super scrappy immigrant entrepreneur family. My parents both immigrated from Thailand and built and ran a variety of small businesses together, and really blessed to grow up with that perspective. Also have a very small family footprint in the US. And my husband is from Minnesota, from Northfield. We have a 75-person family on his side in the Midwest. And so the combination of this professional intrigue of really investing heavily between the coasts for the last bit of my time at Google, and really globally outside of just Silicon Valley, coupled with, our belief that, hey, the future of the innovation economy is going to be written in Minnesota and places like it, with that personal curiosity about, would love to raise my family in a community that is surrounded by literally our family as well. And so that's been a really interesting combination of factors that's played out. And I see in a lot of our entrepreneur community here, we have a lot of either folks who've moved back, maybe one partner is from here, or they moved here for work and stayed for 30 years. You see a lot of us who are not originally from here, who are now really just sounding the drum, if you will.
Yeah, that's awesome. Thank you for that. That adds some really beautiful perspective there. So you both mentioned that you invest kind of across the US, and I imagine that means that a lot of the investment process is now virtual as well, which means that you don't actually end up it doesn't really matter where you are. And from that perspective, being halfway between the coasts on a happy time zone seems to make a lot of sense. Justin, how do you look at that from your perspective? Like, what is your deal flow source, and how do you find your target investments?
Yeah, good question. I'll mention a couple of things. So first off, kind of one of the core kind of beliefs in Rally is that we wanted to have a small, nimble firm with a relatively small number of general partners for quick decision making so that we could react at the speed that entrepreneurs want us to react with. But we want to have a huge amount of capacity in terms of advisors, mentors. We want this to feel as though you're getting the resources of a very, very large venture firm. So we actually have this concept called tech partners. So we've got about 100 individual technologists that we invite to participate in each of our 4 funds. And those 100 individuals have thus far contributed, more than $100 million of their own money. So these are meaningful investors in the fund, and 100% of them are investors. What effectively ends up happening then is when they become an investor in Rally and when they formally agree to become a tech partner, they're agreeing to gratis, give a certain amount of their time to the portfolio. And that group of people is roughly 1/3 divided between Silicon Valley, the Midwest, and the East Coast. And these are just, household name technologists. It's your chief revenue officer at Stripe. It's your CIO at Google. It's just an incredible group of founders and executives. And what ends up happening is that they then tell their colleagues, their friends, the people that they know and believe in, that if you're building a company, we believe you should talk to Rally. And that ends up coming to us as nearly proprietary deal flow. So if you look at our pipeline, the pipeline is almost a perfect overlay of physically where our venture partners are located. And thus far, they've contributed roughly 60% of all Rally deals. So of the 70 checks we've written, the 70 investments we've made, about 60% of them have been sourced by a tech partner. And it's a long way of saying that we really believe still in physical personal relationships. We make our investment decisions often remote and via Zoom, no different than anybody else. But to the extent that we can have somebody in that physical location with the founder, capable of helping them, capable of being there for a coffee, being there when times are tough, that's a big benefit to us. And it's a really important part of our kind of strategic belief. So if we have a tech partner that can get to know the founder personally, that can add some real feet on the street color to our investment decision, then it adds a lot of confidence to us when we're kind of making that call, sometimes remotely, sometimes via video. I will also say that we've been very adamant about having this 2-office structure. Roughly half the team in the Menlo Park office, roughly half the team in the Minneapolis office. And every deal we look at, we ask the same question, which is this the best deal in Minnesota or is it the best deal in the country? And if it doesn't cross the Silicon Valley quality bar, we won't do the deal. So that's been a really important lens for us as we kind of look coast to coast.
Yeah, no, that makes a lot of sense. I just have a quick follow-up question on your tech partners. Are these high net worth individuals who operate within companies, or are these kind of CVC type investments?
Yeah, good question. So that particular group, so the majority of Rally Limited partners are traditional endowments, foundations, family offices, et cetera. But the tech partner group specifically, those 100 people, almost all of those are high net worth individuals. They're all investing as an individual. I would say roughly half of those are active, probably a little bit more than half actually are actively operating in a seat. They're a current founder, a current CRO, a current head of engineering, a current CRO. Some are at, your large FANG companies, some are at smaller startups, but something in the ballpark of, call it 50 to 60% of those are actively operating. And then there's another group of them who may have sold their last company, have a lot more time on their hands, maybe in retirement or semi-retirement, and have even more time to give to the portfolio. So that's kind of how it divides up.
Yeah, no, thank you. That's really helpful. So Mary, same question to you. Deal flow, where does it come from and how does it flow to the frozen north?
It's not always frozen. You should come visit us in the summer too.
I go to Norway. I'm very familiar with the climate and I love it. It's right. There's definitely a draw there. I'm not going to lie.
I'm adjusting to winter. I'm not going to lie. But from a deal flow perspective, so we average making about 1 new initial investment per month. So about 12 a year is our target. We see about 1,500 new opportunities a year. And that's a combination of both inbound reactive and then outbound proactive sourcing that we do. And so I'd say the primary, there's several sources. A large one is, right, referrals from other funds in our network. We have about 450 firms that we actively have relationships with. We have a lot of referrals from founders, both founders we've invested in the portfolio and founders that are in our general orbit as well. We are proactive in sourcing within the verticals that we're interested in. We publish a thesis for each vertical each year and really try to, be hunting for great opportunities within those. And then a really important category for us is having an open door policy. We say we want to be the front door to the Minnesota seed stage ecosystem and beyond Minnesota as well, for sure. But that comes in the way of having open office hours. This is something that we've done since our inception. Every member of our team does open office hours every week. You can book time on our calendar virtually from anywhere in the world. These 20-minute quick coffee, virtual coffee chats. And I would say that via that, as well as just taking cold inbound emails, has directly resulted in some terrific investments that, founders that were from cities that truly lack access to capital. In one case, 2 female founders bootstrapped a company to $700K in ARR, right? Bootstrapped, zero funding. How do we find more of those opportunities? By having a front door. And we know that venture is traditionally a closed network access industry, which is very, very frustrating. And part of our goal is to try to change the equation there. And so it's some of these simple but intentional practices of thinking about intentionality around who are the limited partners who are investing in the fund, what's the composition of the team, who is writing checks and supporting investments, and then how do we help our companies, right? Think about recruiting, retention, who's on their boards, because we really believe that investing in diverse teams directly leads to better financial ROI. And so that is a long-winded way of saying we're really trying to take a broad approach, right, to how we source deals and source them a bit differently. And if you look at the numbers within our portfolio, we have 52% of our portfolio companies are led by female founders, and 69% of our companies have at least one founder who's a person of color. And that isn't a result of any quotas, it's a result of some modifications and intentionality around how we source deal flow. So I wanted to mention that because, and being here in the middle of the country, huge advantages from a time zone perspective, yes, but the MSP airport, if you've ever flown through, it's truly top notch, and you're 3.5-hour direct flight or less from pretty much anywhere you want to go. So that's definitely taken the barrier down. We hosted this summer our first in-person Bread and Butter Founder Summit since the pandemic began, and we're able to have 50 teams come to town pretty seamlessly, and that in-person time absolutely matters.
Yeah, for sure. I'm also curious, you mentioned the bi-coastal kind of aspect of investing, and there's always this piece that springs to mind for me. Like it's kind of easy to invest in people who come tumbling out of Stanford or MIT, right? And if you position yourself in a city that isn't one of those, you're already doing a step towards diversity and like looking at the population of founders differently. And Mary, you just mentioned that you see that in your portfolio already. Justin, are you experiencing the same thing?
We are, yeah. So it's a big kind of like fundamental pillar of the rally strategy, exactly to your point and exactly to Mary's point before. So simply by having a technical majority, but a meaningful percent of the team based in Minneapolis means that we're not seeing companies that investors on either coast are seeing. So exactly to your point right there, we're just naturally looking at different founders, different ideas, things that, frankly, aren't always viewed as hot companies, but companies that we can build conviction in and fundamentally believe in. And to your exact point, diversity of thought, diversity of founder makeup is incredibly important to us. Just from our own portfolio perspective, I was just looking at some numbers. So 75% of the 2022 investments we've made have been in a team with a diverse founding team. 58% of all of our investments in Fund 4 have been into teams with diverse founding teams. And those are numbers that, we're really, really proud of, but we have to remember that it comes with a lot of intentionality in the actual funnel. So at the very, very beginning of the pipeline, we have to be talking to our tech partners and our kind of funnel deal sources about the fact that you aren't looking always for somebody that looks like you. You're looking for talented founders. You're looking for sometimes rogue ideas. You're looking for the most compelling possible new ideas. And you need to be very, very intentional about how you source those to ensure that we've got just a very, very diverse and, sometimes non-conventional pipeline to make sure that it ultimately is reflective in the portfolio construction.
Yeah. I'm loving that. And I feel like it means that you both operate with a more open door than perhaps some other VCs. We've got a couple of minutes left here, and I was curious, what do you wish you could see more of? Through that open door, what do you hope walks in? Mary, do you want to start that one?
In terms of more for the ecosystem, I would say, it's a very collaborative ecosystem here. I would love to see more meaningful shots on goal and more candid, direct feedback, sought out and given early on in the process, right? And something that we do see in the Silicon Valley culture is just extreme, brutal directness, right? Ship a product early and often, get feedback early, iterate. And I think that type of just very, very quick iteration is really key to success. And I'd love to see more of that in our ecosystem here. In terms of types of companies that I like to see, generally we have just huge interest in several areas, but I'll speak just briefly. Digital health is one that we've been deep in, looking broadly at women's health, at behavioral health, at AI automation and infrastructure, social determinants of health, and elder care aging in place. Those are some of the big themes. Within enterprise SaaS, we've really been going deep into the future of supply chain, the future of work and workforce development. Within food tech, we're looking at sustainability, alternative proteins, reverse logistics. Again, the messy middle, as my partner Brett calls it, is everything from on-farm, supply chain, manufacturing, distribution, retail. We don't invest in food products, CPG food products. So those are some of the things that we're really, really keen to dig more into.
Super, thank you. Justin, what do you want to see more of?
If I could steal Mary's answer on the kind of the direct feedback, the first comment she made, I completely agree with that. I'd say in terms of company type, a big part of our thesis at Rally, kind of a third of our investment focuses on this concept called SaaS Plus, which is that's what my prior company, that's what Sports Engine was, but it's the concept that you can build a software platform in a vertical market serving a particular industry. And ultimately, when you become a platform of record, the industry so relies on you, you then have the ability to add in additional revenue streams. You have the ability to add in payment processing, treasury management, funds distribution. You have the ability to sell insurance white label through your platform. You have the ability to embed background screening. You have the ability to roll out embedded lending and effectively take over the banking relationships that the customers often typically had with a local or regional bank. What we found at our company is that the SaaS fee generated from a given customer, we were ultimately able to 10x that by adding the plus, plus, plus on top of the SaaS. So the average $10,000 ARR customer can become a $100,000 ARR customer simply by capturing all of the additional revenue that comes from the embedded fintech on top of the SaaS platform. So that's an area where we really, we feel strongly that the Rally SaaS Plus playbook is kind of unlike any other playbook that exists in the country. We've done it ourselves from 0 to 100 million plus. And if there was anything we'd like to see more of, it would be more vertical SaaS companies that have a real point of view on how they become a SaaS plus company in their given vertical. So yeah, if I could wave a magic wand, I'd like to see more of that in the pipeline.
Well, your magic wand is in the mail. Mary, Justin, thank you so much for taking the time to come and talk to us. And yeah, I'm going to have to come and visit Minneapolis sooner rather than later, I think.
Yeah,
thank you, Haya. Please do.
There's always been an innovation economy, and JP Morgan has an entire business dedicated to helping it thrive. By bringing together founders, startups, investors, and ideas, JP Morgan's commercial bank helps empower thousands of high-growth companies that are shaping the present and the future. With tailored banking solutions and a global business network, JP Morgan helps innovators scale for today and tomorrow. Visit jpmorgan.com/startups to find out how they can help you build your future. products and services of JP Morgan Chase & Company and its affiliates are subject to availability, eligibility, and applicable terms and policies. JP Morgan Chase Bank, N.A., member FDIC.
Hey everyone, I'm Anita Ramaswamy. I am a senior fintech and crypto reporter at TechCrunch, and today I'm going to be chatting with Atif Siddiqui from Branch, a fintech company headquartered in Minneapolis, Minnesota, and Ryan Broshar, who's an investor at a local venture firm called Matchstick Ventures. We have a lot to get into today, so I guess I'll start by diving right into it. Atif, it's great to have you here. I think a good place to start might be if you wouldn't mind just giving us a little background on what you do at Branch and what the company's all about.
Definitely. No, thanks for having me. Founder CEO of Branch. At Branch, we really work with businesses to help accelerate payments to empower workers. I founded Branch back in 2015 to really find ways to improve the financial lives of working Americans. And one way we've been able to do that is by helping them with their cash flow, getting payments to them faster. And so it's been really great to, start the company and grow here in the Midwest. We're about 150 employees now. When we first came to the Midwest, about 3 employees. So really been stellar growth over the last couple of years.
Awesome. Yeah. And just for a little context that I have, you guys last fundraised in March of this year. That's right?
That's correct. Yeah. We announced our Series C for $75 million this March.
Awesome. Yeah. And speaking of funding, Ryan, if you want to share a little background on Matchstick and what you do, that would be great as well.
Sure. Yeah. I'm Ryan Broshar from Matchstick Ventures, and we are a pre-seed and seed stage venture capital fund with offices here in Minneapolis. And I also have a partner in Boulder, Colorado. So we invest in companies that have ties back to our regions and have been doing so for the last 8 or 9 years. We're currently on our 3rd fund. It's a $53 million fund focusing on startups in our regions. Awesome.
And Branch is one of your investments, right?
Yes, it was. It was one of our very first investments from Fund 1. At the time, I was also running the Techstars Retail Accelerator, and made an early investment in Branch way back when.
So Atif, I know you have sort of an interesting story of how you ended up in Minneapolis and how the company ended up there, but it did not start there, if I recall correctly. Can you share a little bit of the story that sort of what led you to Minnesota?
Yeah, no, we founded the company in Los Angeles, actually. So originally from Southern California. I founded the company as an EIR at Idea Lab. It's a big technology studio incubator in Pasadena. What led us to Minneapolis was really the Techstars Target Retail Accelerator. So at the time, we had a lot of retail employees using our product. Target, we had a pretty high concentration of just employees adopting it organically. And so we applied to the program, and, it was indeed a problem they were looking to solve, just better, workplace technologies, people using their mobile phones for, work-related activity. And so we got in and, we worked closely with Target and had access to really, anyone from the C-suite down to store employees to test out our product. And really what kept us in Minneapolis long after the program was that we're really finding great talent in and around the Twin Cities, specifically for our model, which is, B2B sales focus. So good talent around sales, account management, customer success, and even engineers that really understand how to work with large companies. And, what started with a team of 3 when we first moved, continued to grow. And shortly thereafter, we called Minneapolis home.
Yeah. And how big are you today?
We're about 150 employees now.
Awesome. And I guess I'm curious about, the move to Minneapolis. What sort of sectors are you mostly focused on at Branch? Who are you working with mainly?
Yeah, in terms of sectors, I think initially we started around quick service restaurants and retail. Minneapolis being a good hub, there's a lot of quick service restaurant headquarters there, as well as retailers like Target. As of late, we've expanded more into logistics, so last mile delivery. Some other new verticals we're opening up around healthcare and healthcare staffing. I think one of the things that we were kind of mindful of as we built out the company is just being able to take our product into different industry verticals. And I think this pain point of getting money faster is not unique to any one industry, and it helps workers across the spectrum.
Yeah. And I guess this, I want to transition into talking a little bit about the funding ecosystem and the venture ecosystem in Minneapolis, which I know, Ryan, you will totally be able to speak to. What is it like for companies in Minneapolis, especially fintech companies, looking to raise capital. I guess maybe if you can speak a little to your experience, then Ryan can share a little more on the broader ecosystem.
Yeah, I'll say the ecosystem is growing. I think one of the things, again, that helped us early on was the relationship we had with big corporate partners that we were working with. So that was a plus. In terms of early stage, raising money in Midwest, companies like Matchstick have emerged. I think there was also a great network of angels from the Midwest that we were able to close out our early rounds. And so it's been great, I think, for an early stage company.
And just one thing to note before we dive a little deeper into the Minneapolis side of things, I know that you also raised funding from some VC firms on the coast. Can you talk a little bit about how that came together? And I guess, did you feel that you had no choice but to go to the coast to raise money, or was that an intentional choice on your part?
Yeah, I think it was a little bit of both, right? I think we do have a large investor, Drive Capital, based out of Columbus, Ohio, that was able to provide some more growth equity side capital. But with their network too, we were able to get some later stage funds interested who happened to be on the coast, but also had other investments in Midwest. So it wasn't entirely new to them investing in the region either.
Got it. So would you say you sort of expanded from having some local investors support you early on and then sort of expanded your investor base as you grew?
That's correct. Yeah, I think as you grow, we expanded. So yeah, our Series C was led by Addition, which is based out of New York.
Got it. And Ryan, I'd love to hear your thoughts on what you've been seeing in terms of how the Minneapolis venture ecosystem has evolved. How long have you been there, and what are the changes that you've been noticing?
Sure. Yeah. So I've been involved in the local ecosystem for over 10 years now. And really, when I got involved 10 years ago, it was really non-existent. It went from a few groups supporting startups, doing whatever. There wasn't much of a seed stage infrastructure for investing, it's dramatically changed over those 10 years. There's multiple groups within the local ecosystem supporting startups at very early stages. We've had up to 3 TechStars programs running here at any time over the last few years, including the retail program. We have a farm to fork program with Cargo and Ecolab. We also have a sports program with the Minnesota Twins. And so, you're starting to see this kind of national, if not international, startup ecosystem players putting up their flag here of wanting to tap into the local ecosystem. And that's really starting to take root. Companies like Branch and others have moved here because of that, which has been really great. So the local funding ecosystem has evolved as well. So now there's multiple seed stage funds in the market that we work with very closely. We're starting to see more so companies like Branch who are setting up here, but also it's growth stage investors from the coast more and more willing to invest in companies in our regions. It's not, Minneapolis is not an area to be taken lightly when it comes for sourcing deals for the coast, and we get those connections all the time for our portfolio companies.
So I know one of the advantages that Atif mentioned of building in Minneapolis has been talent, and I'd love to hear your thoughts from both of you. What are some of the other areas or other advantages that you think you have just sort of building a company in Minneapolis, or that Minneapolis-based companies have? Maybe even compared to like the Bay Area or other regions like that.
Sure, I can start this one. So I think one of the main advantages you have, and Atif kind of alluded to this earlier, is we've got, I think it's 18 Fortune 500 companies in our region, or just in the Twin Cities itself, which is like one of the highest per capita, I think, in the country. It's got to be. And so what's nice about that is if you're, let's say a B2B enterprise company or something, you're basically 1 degree away from very important people that have, at these large corporations that you can start to gain relationships with. It might be like your uncle's cousin or, something that's kind of natural, easy progression, but more likely than not, you're 1 degree away from, someone who could really change the course of an early stage startup. So if you think about the kind of early customer adoption, that can be a huge advantage for a startup to land a customer like United Health Group or Cargill or, Target as an early customer, and then be able to expand that, nationally, if not internationally, into more customer base. Those are big logos, right? Like that you can have on your on your companies. So I think it's a huge advantage from like a business development perspective.
Yeah, to echo that, I think, similarly, it's the ecosystem of potential customers big, but I think also, when it comes to hiring, you get a lot of people that are now looking for opportunities at startups that maybe had worked at some of those companies. And so it's a natural way to get like industry experts, right? People that with deep domain expertise also to, work for a startup.
When it comes to your employee base, Atif, how do you sort of, I guess, convince people to stay in the area? How do you look at retention of talent within the Minneapolis region?
Yeah, I would say our retention's been really, really strong. One of the things that, we've been able to do as we grow too is just like educate, employees about a path, like a career path within startups and show them that progression. So that's been a little bit of an education process because, I think when you look at the coast and just network effects of people and experiences, it's, a lot of people at startups and it's, but for the Midwest, it might be new, right? As Ryan mentioned, there's a lot of larger companies and there's a bigger kind of company culture potentially, but a lot of that education, I think, has been big to just show a career path and what they can achieve at a startup.
I know one advantage, last time we chatted that you had mentioned, Atif, was also just sort of being able to build at an early stage in a place that might not be more expensive. Like maybe your funding gets you further. Is that what your experience was when you were sort of early stage building Branch?
I think early stages, sure. I think, post-pandemic, that's kind of equalized a bit where, anybody can work anywhere. But earlier stages, I mean, if you look at like 5 years ago, there was a little bit of that where challenge, was a little bit lower than what was being offered on the coast.
I want to talk a little bit more about Branch specifically. I know that you have been sort of focused on expense management for these freight and logistics sort of trucking companies. Can you tell me a little more about that pivot?
Yeah.
So rather the area of focus that you've recently found, right?
Yeah. So, one of the partners that we work with, Uber Freight, and so we power sort of faster payments for their drivers and single owner operators and carriers. And, one of the things that we were looking to expand into was oftentimes these carriers might have other expenses or other workers they need to pay. And so just a natural extension now of offering them more tools when it comes to faster payments to them run their business, right? And so, we're looking to see if these cards can apply to other industry verticals as well, even outside of freight.
And when did you sort of start looking seriously into that vertical for Branch?
Logistics has always been really strong. I think just from where we again really can provide a lot of value is that anytime there's a delay in payments to workers. And so initially when we were focused on W-2 workers, it was more, the 2-week pay cycle. But when you think about trucking and logistics, sometimes these drivers have to wait net 30, net 60, net 90 for payments. And so for them, it's a big working capital need so they can get back on the road and grow their own business. And so it just made a lot of sense, I think, just looking how big the industry is, logistics industry, and the amount of delay in payments.
Brian, I want to ask you, I'm sure that you see a number of different deals in the fintech space. It's been pretty hot. And, specifically within this area of, getting workers paid faster. I know there's a bunch of startups kind of working in that space. What stood out to you about Branch when you were first meeting Atif and the team?
Yeah, well, we invested very early on. So I think it was literally a team of 3 when Atif mentioned. So, and it's gone through some iterations of like what the product was. So, I mean, I think for us, what is always stood out for Branch is just the addressable market of like where they can serve, right? Like logistics is just one of those verticals there. There's also retail. There's also, fast service restaurants. Like it can really play the gamut of that. And that's, from a Matchstick perspective, that's a huge thing for us, is just the addressable market of like where they can go with it. And, second is just like the team itself, right? Like we invested so early, we had to trust that the team was going to be able to find the product market fit, into that market. And clearly they've found it. So, but, I think from a fintech perspective in the Twin Cities, it's actually in their application of it, of Branch to the market makes a lot of sense. I mean, there's a very clear need in the market for people to get paid on time, right, for the work that they have. So when they started to hone in on this as their market, it made a ton of sense, right? And in, like you said, the market opportunity there is quite large. So we're really excited about where they're headed.
Awesome. And this might be more of a question for Atif, but what does this mean for your customers? Like, why is it that they would want to actually have their employees be paid faster and in a more cost-effective manner? Like, is it a recruitment thing or?
Yeah, 100%. I think companies turn to us because they're looking to attract and retain talent, right? A lot of the industries we work in have high degree of turnover. And so they're looking at, financial tools and financial benefits that they can provide to their employees that would really help their employees with their, financial peace of mind and provide them more financial security and stability. And so, in addition to just faster payments, we've really just built a suite of kind of financial services to help them. Things like, helping them budget. It's allowing them just more free, transparent banking options. And so, we do see, I think almost 1 out of 4 users now use Branch as their primary account, right? Just because it's a better banking service at the end of the day.
And in terms of your customers, are they concentrated within the Midwest, or are they sort of distributed across the country?
They're distributed across the country. I think we, again, work across many industry verticals. So yeah, pretty spread out.
What does the competitive landscape look like in this space? Who are the other players? Where are they based? How are they doing things differently from maybe what you're doing at Branch?
Yeah, I think the way we look at competition is, you have startups that are providing earned wage access. You have kind of legacy pay cards that have some, way to bank and unbanked individuals. And then you have more of the newer sort of banking as a service platforms, right? That are, they also handle payouts. And so I think that where we sit is this interesting intersection, right, of sort of like HR tech plus financial services, right? And so we've taken really the B2B route as a way to go to market. And it's proven, a good way to not only acquire users, but the product's really, really sticky when it's inside of the organization.
I guess moving back to, some of the discussion we were having around fundraising and what that's like, did you find that your conversations going out to investors were sort of different based on, the more regionally focused players versus maybe some of the larger coastal players?
I think in general, the investors that we brought on from the Midwest really understand kind of what we were doing. I think market, again, in the Midwest, pretty educated on early stage investing, especially even our angel. Like when I look back on our really, really early investors in that seed round, they were pretty sophisticated. And I think they were looking, quite frankly, for startups like Branch in the region. I think that's the one thing that was missing. Like we just need more of these companies being built here.
Do you have any advice or any tips for founders who, like yourself, are fundraising out of the Midwest for companies that have more of a national ambitions?
Yeah, I would say, a lot of resources now and places to start. Things like Techstars, I think, is a great example of a way that you can kind of grow your network, right? So when you join a program like that, there's just built-in networks already that you can kind of tap into.
Yeah, so you were talking about the Techstars network. I don't know if you have anything to add there, or if Ryan, maybe you want to jump in and mention any other resources or tips or advice.
Yeah, I think Techstars is great because it's got, you can plug into the local network immediately because all the mentors and everything are typically local and or very industry specific. But then you also have the national, international network of Techstars, so it kind of branches out from there. And I think for a non-coastal market like ours, that's a really big deal, right? Is not only to have the resources of your local market, but being able to tap into that bigger thing. I mean, it helps kind of level you up, I think, as a founder as well, to kind of know what our founders doing all across country. I think one thing we focus a lot on at Matchstick too is we always say that we don't invest in the best startups in our region. We invest in the best companies in the world that happen to be based in our regions, right? And I think that's a very different mindset of just hey, if you're in technology and you're selling, eventually you're going to be going national, if not international, and you need to be the best company in the world doing that because you're going to be competing against all the companies, internationally there. So I think just that mindset shift of, being local, which is great, a lot of great resources there, but also just kind of really understanding how big you need to become, who you're going to be competing against, and shifting your mindset a bit. And, programs like Techstars and or just having coastal investors on your cap table can, really up your game when it comes to understanding, the future of your business.
Yeah, that actually reminds me of, a question that's been top of my mind as we sort of have this conversation, which is just that, obviously the world has changed pretty significantly after and like during the pandemic, where with, this sort of shift to remote or hybrid work. What trends have you been seeing on that side, Ryan, among startups and how they're choosing to handle that?
Yeah, well, I mean, we see it all the time. Like I probably get one or two people a week from the coast who are moving back to Minnesota or, moving to this region because maybe they're from here, maybe they have some sort of connection, they lived here, and they just have more flexibility in their time. So they're deciding to move like their life here and then can try to continue their same jobs. Like, so that trend is 100%. I'm seeing it on the ground all the time here. So that's very common. You're also starting to see more companies who are based here do similar stuff to our branch, right? Where they have like their headquarters here, but then, once they get to a certain scale, they start to scale out their team into new offices, into, different domain expertise in different offices, et cetera. And you're starting to see companies be kind of much more, national very quickly, even though their headquarters are based here. And I think you're seeing that. I don't think that's unique to Minneapolis, but it's probably more so just because the market's a little bit smaller and you do need to, expand once you get into that larger thing. And I think that's fine. Like, I think it's actually a really smart business move for companies to have, offices where the talent is, right? And where their customers are.
Yeah. And Atif, I want to know how you're sort of handling this from the branch side in terms of, return to office and those sorts of questions with your employees.
Yeah, like most companies, we moved to a remote first model. And what that meant was like we're hiring talent everywhere. But, as Ryan mentioned, we do have another office we set up in Tampa Bay, Florida, which is served as like a sales office, and they do go to market. And, typically it's like you hire leaders and they hire within their networks. And so it's worked out really well, to kind of have these hubs. But yeah, it is a remote first model. And I think, we've been growing like really quickly, like, doubling headcount almost year over year for the last couple of years. And so it's been a great way to grow.
Yeah. And it sounds like growth has been pretty fast. I guess that brings me to a question I want to ask, which is what are you most excited about in the next year or so for Branch?
Yeah, for us, it's really on expanding into new market verticals. We have new products that we're looking forward to launching too, again, just along the lines of helping working Americans growing financially. And then, finding the right people to join us on this ride. It's been really fun. And so we're actively hiring. And those are three of the things.
Any specific verticals or like areas within your team that you're looking to hire in or grow?
Yeah, we're always looking for great sales leadership. And so, all across go-to-market functions, actually, sales, customer success, marketing.
Yeah, I want to wrap this with, like a more personal question, I guess, since both of you, ended up moving to Minneapolis at some point. I want to know what was maybe the biggest challenge you faced and the thing that you liked the most about the decision you made.
Sure.
More from a personal perspective than a business standpoint, because we've covered that.
Yeah, totally. So I moved back to Minnesota about 10 years ago after living in Colorado for some time. And, one of the blessings and the curse with Minnesota is there's so many people who are from here are like, have connections here. So they already have like ingrained networks that they're kind of tied into. But once you like tap into some of those networks, it's really great because you have, like I said, access to a lot of it. So I would say like that was kind of like a shift, right? Where you're kind of moving into a new market and most people are from that market originally. And then, but there again, like once you get through it, so that's I think it's a positive, but it can be a tough nut to crack sometimes.
And I think for me, I'll call out the obvious. Moving from LA, it's just the weather and adjusting.
I've never done that, so I was wondering about that.
Yeah. And so, but like Ryan said, I think, breaking into networks is a big thing. And luckily, we've been able to grow the team there. So that naturally built in networks and we were able to expand. But again, it's been a great place. I think personally too, we raised a family there, started a family in the Midwest, and it's a great place for kids and to grow. So.
Awesome. And I guess I'll ask the question I asked Atif earlier to you, Ryan, as well. What are you most excited to see Branch do in the next couple of years?
Oh man, I'm just trying to hold on to this rocket ship for as long as I can and support them, wherever I can. I'm so proud of and grateful for the opportunity to be an early supporter of them and been along for the journey here. So I think this is going to be a great year, into this year and definitely into next year for Branch. So I'm just here, in the cheering section at this point.
Awesome. Well, watch this space. It was great talking to both of you. And just to recap, Atif Siddiqui from Branch and Ryan Broshar from Matchstick Ventures. Thank you so much both for your time. It was a great conversation.
Thank you.
Great. Thank you.
Hey everyone, welcome back. This has been a great day and I've enjoyed all these panels. Minneapolis is just a fantastic city. I live in Michigan and I really do care about the flyover states, and that term is offensive to me and I don't really like using it, but it is definitely something that people use. So with that being said, thank you for watching so far, and we have one last panel for the day, and this is a pitch competition. So unlike pitch practice that we do every week on TechCrunch Live, there's a prize for this, and it's a competition. So we have 3 local Minneapolis startups presenting to 2 outside investors. But let me introduce these investors to you. So I'm going to read their bios, and then we'll introduce the first company. Okay. First judge of Mahati Sridhar, Vice President, Rise of the Rest Fund. Mahati is I'm reading something too, so I'm gonna look over here. Mahati is a Vice President on the investment team at Revolution's Rise of the Rest Fund. She joined the firm in 2021 and focuses on sourcing, due diligence, and supporting existing portfolio companies. Prior to joining Revolution, Mahati was an associate at Bull City Venture Partners, a Durham-based venture capital fund where she worked on seed and Series A software and internet investments in the Southeast and Mid-Atlantic. Mahati is also a Venture for America Fellow and served her fellowship in Charlotte, where she helped launch CFV Ventures, an early-stage fintech-focused venture fund. She started her career in investment banking at SunTrust Robinson Humphrey, where she worked on the healthcare coverage team. Next, we have Sarah Hinkfist, partner at Bain Capital Ventures. Sarah works with growth stage founders across both applications, software, and fintech. She's particularly interested in backing founders who have personal experience in the market they're creating. Sarah joined Bain Capital in 2020 as vice president on the tech opportunity team. Prior to joining Bain Capital, Sarah worked as an associate in KKR's growth equity group in San Francisco. Prior to that, she was senior vice president at Applied Predictive Technology, an enterprise SaaS company acquired by MasterCard in 2015. And I just learned she is from Wisconsin. Okay, well, Sarah, Mahati, thank you for joining us. The format for today's event is these companies have 4 minutes to present their companies with a pitch deck, and then we have up to 5 minutes to ask them follow-on questions. The first company going the first company going is Axion Athletics, and presenting at Axion, we have Jordan Johnson, founder and CEO. Jordan, are you here?
I'm here. Good to go.
All right, fantastic. Well, you have 4 minutes to present your company, starting now.
I had made the decision to play college football. I made it about 3 days into fall camp. I'm sitting alone in my dorm room. I'm at my desk underneath my bunk bed, and I'm looking out across the room through the window. And in that moment, my vision started to go blurry. I started to sweat profusely. It actually felt like someone had taken a knife and kind of stubbed it right into my chest. And so I should also start by saying that I'm a firm believer in the power of sport. However, there is a dark side to it. So I ended up having a panic attack in the dorm room that day and inevitably stepped away from the team. However, I did return to campus a few weeks later with this new sense of curiosity. And what I really wanted to understand was this interaction between the mind and the body specifically within the context of sport. And so really spent the next 6 years trying to do just that. Studied psychology. I joined the track and field team and eventually completed a master's degree in sports psychology. And if we could go to the next slide, please. One of the things that I quickly realized was the mental health crisis in college athletics. Now, research by the NCAA and other institutions have found that 1 in 3 student athletes experience a symptom related to a mental health problem. However, only 10% of these student athletes will actually seek out the professional help that they need. And so if we can go to the next slide, please. One of the things that we can see is it basically comes down to 3 factors. There's the mental health stigma, there's the burnout among the administrators within these sport organizations, and then there's the bottom line, the money component that really makes these barriers between student athletes and the mental health support that they need. And so we go to the next slide, please. One of the things that at Axon Athletics we're trying to do is we're giving athletes access to an online training dashboard. And so what does this look like? Student athlete goes back into their dorm room, they take out their phone or their laptop, and voila, they're into the application. Now, the primary way that they interface with the application is by completing AI-driven mindset workouts. And so what that looks like in the short term is using self-rated wellness data. How is your sleep, your energy, your mood, and using that to inform which exercises are specific to that individual. In the long term, though, that's integrating with more passive means of data collection, whether it's through like a smartwatch or relying on more sophisticated forms of machine learning and artificial intelligence. And so if we go to the next slide, please. One of the things that we're really trying to do in terms of tackling this problem is also offset the financial burden associated with providing mental health resources to all of these different sport organizations. And so basically, Axon's going to be relying on 2 streams of revenue. The first stream is going to actually be partnering with these given organizations on a subscription model. And so looking at anywhere from youth all the way up to Division I and kind of everywhere in between, but then also partnering with businesses in the community as a way to kind of offset some of that financial burden. And so what that looks like within the application to have promote adherence to training, athletes are awarded a certain number of points that they can use to cash in on certain offers. Now, these offers are going to be with businesses that we believe are like-minded. We're probably not going to have a liquor company advertising on our platform, more sport-oriented businesses. So if we can go to the next slide, please. One of the things that we can see from a market opportunity at $100 per student athlete price point, considering both the subscriptions from the sport organizations and the businesses, looking at about 57 million in ARR. And then that obviously expands to looking at all student athletes, and then all students at about 7.5 billion in ARR when we kind of tap into all students. So we go to the next slide, please. Now, as I stand here before you today, I'm very aware of the fact that in order to tackle a vision like this, I can't do it myself. I don't have the skills or the abilities, and really it comes down to building a team. And so we've started to assemble that small team, but at the end of the day, it really comes down to a vision, a village of people rowing in the same direction. And so I stand before you today just asking for feedback. What are we doing well? What are we doing wrong? And would love to answer any questions about myself or Axon Athletics. So.
Very good. Thank you so much, Jordan. Sarah, can we start with you, please?
Definitely. Thanks, Jordan, for sharing. I really appreciated your connection to the problem as well. And thank you for sharing such a personal story with us. My husband's actually, he was a D1 athlete as well through college and professional. And so I'm familiar with the challenges that you're describing in mental health. And it definitely resonates as being a really important space to find better solutions today. One question I had for you is you talked about, as you think about the TAM or the market size, there's the price point, which you identified, and then there's also the number of people who would be applicable. And I'm curious if you think that for student athletes in particular, it's just a body that is better studied. And so that's why we have more statistics around the incidence of mental health issues, or if this is actually something that would be applicable to the entire student body, as you kind of talked about in the TAM slide at the end.
Great question. Great question. So based on kind of the research that I've done and the research that I pulled from other people is in terms of the incidences of like mental health symptomology, the numbers are pretty consistent in terms of like that 1 in 3 statistic that I was sharing earlier. However, the one distinction between student athletes and just like the general student population is going to be the reporting statistic. So at that 10%, student athletes are going to be well below what the reporting statistic is going to be for more of the general student body. So to answer your question, I definitely still think there's room to apply something like this to all students. But at the end of the day, I do think that what makes student athletes different is that need or that desire to kind of report these different things, right? As athletes, we're taught to be tough, we're taught to be gritty, to fight through the pain, to pull ourselves up by our bootstraps. Exactly. And so when you kind of layer those two things together, I think it definitely makes it very challenging for student athletes in particular. So,
thank you.
Hey, Jordan, thank you again for sharing your story. Much like Sarah, my younger sister is currently a D1 athlete, so completely understand exactly what kind of universe student athletes live within. I'd love to lean in a little bit more and talk about the student athlete lifestyle. As you alluded to, every second of every minute of every day is scheduled. And so even carving out time to practice this mindfulness and to spend time within this app is taking away time from something else that the student athlete would be doing. So how are you encouraging athletes to prioritize leveraging a tool like this?
Absolutely. That is a great question. So one of the things that we've really thought about or really kind of want to tap into is the competitiveness of student athletes while also being conscientious of the time component that you're kind of alluding to. And so we're designing our exercises in the way that they interface with the application to be completed with anywhere between like 3 minutes to 5 minutes. So really, hopefully a short amount of time in what I view, and maybe obviously people can disagree if that's a short or a long period of time, and something that we hope to kind of figure out over the next few months here. But the other component in terms of the competitiveness piece is making access to like people simply completing the program available to like team members or organizations. And so what do I mean by that is looking at like, let's say a team level, you're working with a specific football team, for instance, how can we look at the team in total that says, okay, 90% of the workouts allotted for this team this week have been completed. We're not singling out individual athletes and saying, yes, you did, or yes, you didn't do it, but it's just a way to kind of say, okay, this particular team or this particular organization is kind of at this particular level in terms of it actually just adhering to that program. And so we think that could be very beneficial in terms of like between teams within a given institution, but then also hoping at one point to take it between like different institutions. I'm from the University of St. Thomas here in St. Paul. How could the adherence to mental training in the St. Thomas campus compared to those in other institutions like in the Minnesota area, especially people within your conference? And again, just as a way to kind of lean into that competitiveness factor, as a way to really prompt people to want to do it more intrinsically, right, in that capacity. So
I got one question.
Yes.
Can you tell us about your traction?
Yes, absolutely. So the vision for Axon actually kind of came to bear a little bit too, and we developed a little traction last February, won the University of St. Thomas business plan competition and was awarded some seed money to kind of get things up and going. And since then have gone through a business accelerator program this last summer. And then currently I'm in another business accelerator program based here in Minnesota. And then we actually just launched our MVP last week. And so we're on board with a team, getting some things going. And then we have a few others in the pipeline that I won't put out into the universe just quite yet. But very much looking forward to kind of having those guys onboarded within the next month or so here. So
that was very good, Jordan. Thank you so much. We're out of time for you, but best of luck to you. And I have 2 student athletes in my household, so thank you for addressing mental health and athletes.
Yes, thank you. I appreciate it.
Very important topic. Yes, absolutely. All right. Well, we're going to move on to the next company now. Next up, we have Daniel Larson. He's the founder and CEO of Kairos Care. Did I say that right?
Absolutely.
Yeah, great. All right. Well, Kairos Care. Well, you have 4 minutes to present your company, and we're going to start the timer now.
All right, so let's jump into it. My name is Daniel Larson. I'm the CEO and founder of Kairos. If you want to go to the next slide, let's just frame up the problem real quick. So we are a recovery management platform. So we work primarily or exclusively in the mental health and substance use disorder space, right? There's a huge amount of overlap. And so we touch on those things on a daily basis. So if you think about the 2 million people that are looking for treatment today that won't get it. We have about 65% of treatment centers saying that they're at capacity or turning people away. And you got a $53 billion market with no dominant technology player, right? And if you look at that number, that's not including the $32.5 billion in opioid settlements that are still racking up, about to be dumped into this industry as far as trying to solve a problem of not having enough people to help people that desperately need it. And that's at the core of our business. So what we do is we manage a marketplace. So if you go to the next slide, please. we've built a platform that essentially connects qualified individuals and trains people to become qualified individuals. And these are Medicaid and insurance reimbursable services. And they connect with people that they match with either demographically, life experience, and different types of backgrounds, either culturally specific or in other instances, to give them the best opportunity to get the help that they need. And so as a part of that, what we give is an individual provider the ability to skip brick and mortar institutions and have to work for a treatment center like the Hazleton we have in the backyard, or the Malibu Passages that everybody's so familiar with, right? And they can go and become truly independent private practice substance use disorder treatment providers. And so what we do is we give them the technology to have EMR capabilities, find clientele, have ready-made insurance contracts, have malpractice, professional liability, general liability insurance all through our platform. They can log their hours, and then we pay providers once a week, and then we go and bill insurance, and then we take a percentage of that service fees. So a lot of the reason why we are so successful at what we're able to do is that we automate anything that doesn't have to do with actually helping people, right? So these are menial administrative tasks. So when it comes to enforcing charting notes or collecting user-generated data, or all of these things that really make for a distraction from the people that are suffering through this kind of devastating life problem, we automate that for the provider. So this increases their bandwidth, actually increases their billable hours as a service provider, and helps eliminate a lot of that administrative fatigue that they get. The other really neat kind of component of what we do is that we give people in recovery a pathway to become a trained provider, to then become insurance reimbursable themselves, and then turn them into people who make livable wage jobs on our platform. So if you're walking into a substance use disorder and you have just lost everything to an addiction, you actually have a program that forecasts out a year or two that says, hey, stick with this program, work with these providers, we'll give you training, and then we'll turn around and we'll have you help somebody that's in day one of their recovery. So it's got that nice network effect that we like to see out of marketplaces, but also these are people that have really limited their options based on some of their life choices in the past. So we can give them a very fairly certain outcome. So
all right, Daniel, we got to wrap it up here.
Oh, I'm sorry. Just go one more slide here. So basically, we're able to offer the full continuum of care. Hit one more slide, please. And we're able to offer a ton more providers per client, so our ratios are quite a bit better. We offer free training, and then we also can cut down an organization's payment about 50%. And so we can partner with organizations and providers alike. So sorry, I was not catching the full scope of the timer. I just saw double zeros the entire time, so I apologize for that.
No worries at all. You did a very good job. All right, Mahati, let's start with you.
Hey, Daniel, thank you so much for sharing. And this is a very, very like topical solution and space that a lot of folks in our country and families are dealing with. I'd love to lean in a little bit to the professionals and the providers that your platform recruits. What kinds of vetting goes into determining for these individuals to see how they're able to sort of like stand up and be, you know, the professionals on your platform? And what additional training do you all provide for these individuals?
Yeah, so that actual vetting process is state regulated, right? So they have to go through a state regulated process. We have an approved curriculum, so they go through 46.5 hours of training to become a community health worker or a peer recovery specialist. And then we also have compliance and quality standards on our platform. So we have people monitoring different events, making sure that ratios are good, making sure that they comply with Medicaid standards. So we do take a fair amount of quality responsibility onto the platform.
Sarah?
And yeah, definitely. Thank you. Really appreciate it. Maybe switching to the other side of the platform, so not on the provider side, but on the patient side. Are you asking the providers to recruit their own patients, or is that part of the service that the platform or marketplace is providing?
Yeah, so one of the slides that we didn't get to is we're a B2B2C. So we partner today with about 42 organizations. We have about 870 clients onboarded to our platform as of this morning. And we have about 24 organizations in the pipeline. So today we have 23% of the entire peer recovery workforce in the state of Minnesota working on our platform at this capacity.
How are you prioritizing your go-to-market expansion, especially because many of your professionals have to be state mandated and state, qualified?
Yeah, this is one of our most tricky problems, right? And so what we do is we have a team that actually looks at compliance and regulatory environments, and we look for states that have reciprocity already with Minnesota. So we can go in and leverage our same technology. Our next expansion states, Arizona and Ohio. So we've already signed lease space in Arizona, and then we're opening up in Ohio as well in Q3.
And how do the economics for the provider compare to being on their own versus being on your platform?
Yeah, absolutely. So in this particular sense, they're only able to be a part of a group billing situation. But let's talk about medically assisted treatment nurse practitioners that also work on our platform that we didn't touch on. So they make about 25 to 30% more in our independently contracted. We carry all the malpractice insurance billing, but we also float the cash flow. So they're getting paid every 2 weeks instead of every 45 to 60 days from the insurance companies.
I'd love to talk a little bit about retention. So both retention from the provider or the professional side and from the individual patient side as well. So understanding a little bit about what that care continuum looks like. Is the same professional working with the same patient or individual on an ongoing basis? How many interactions are they typically having? And how do you incentivize that those relationships continue to grow and foster for better patient outcomes?
That's a good question.
No, absolutely. So right now they have an average of 2.5 appointments per week that adds up to about 5 hours of care a week. The professionals, we load up caseloads and then either through attrition, right? So you have to imagine in the space you have a fair amount of return to use, but we also have a fair amount of people that go into either peer recovery specialists themselves or graduate their programs. And so we measure retention based on the amount of caseload and ratios that they maintain. So then if they maintain their ratios, we can kind of monitor their caseloads. It's hard to ding them in a strict rating system, but we have actually a layer of clinical supervisors that work with every group of independent contractors, so they're not there by themselves.
Well, I think final question. One of the challenges with B2B2C is that you're managing so many stakeholders, and it can also be a source of opportunity for the network effects that come along with it. Which side of the market are you most constrained on today?
So it'd definitely be on the providers. There's about 12,000 open positions, and there are providers to fill them. So what we've been doing is we've been cross-training in other areas to bring supply in adjacent areas. So when you think about licensed marriage and family therapists or people that are in the social work space, then we bring them into the mental health space and get them cross-trained.
Awesome.
Great answer. Well, that was really interesting. I didn't know a lot of that. Well, thank you, Daniel. Best of luck to you.
Thank you.
All right. Well, we have one more company today. We have Kathy Skinner. She's the founder and CEO of Next Gen Port. Kathy, are you there?
I'm here.
Can you pronounce your company name for me? I'm sure I got it wrong.
No, you got it right. Next Gen Port.
All right, great. Well, fantastic. All yours, Kathy. You have 4 minutes.
20 years ago, cancer came to my house. We all know someone who's been touched by cancer, and for me, it was my father. When my dad was at home and in between treatments, there was no way to keep track of changes in his blood cell counts and his vitals. Sadly, and on more than one occasion, my dad got an infection that landed him in the hospital and delayed his next chemo. Many years later, I was leading an exercise program for cancer patients. The patients were having the same problems as my dad. And I thought, there has got to be a better way. That's why we created NextGen Port. NextGen Port is the first of its kind implanted smart port that detects early signs of infection by measuring changes in blood cell counts, heart function, and vitals. The chemo port has been a standard of care for decades, and we added microelectronics to the port for remote patient monitoring. More importantly, we remove the barrier of patient-reported outcomes by creating a patient experience based on passive data collection. No action by patients is required. By monitoring patients remotely with optical sensors and machine learning, we help cancer patients stay on their treatments longer and provide physicians with the data they need for patient-centric care. 50% of cancer patients undergoing treatment suffer from low white blood cell counts that put them at a higher risk of infection and a possible delay in treatment, and even a higher risk of death. The consequence of this very common side effect costs the US healthcare system $2.3 billion annually. So how does NextGen Port work? We measure blood cells as they flow past our optical system in vivo, much like EasyPass captures the images of license plates of cars as they drive through a toll booth. The combination of blood cell data plus vitals like body temperature and heart rate create a novel data package that we hand off to physicians so they can take action. And these actions help hospital systems increase clinical efficiencies, manage their costs, and improve patient care. Looking at the size of the market, 19 million people around the world are diagnosed with cancer every year. 3 million patients are eligible for an implanted chemotherapy port. Our forecast shows a $750 million annual recurring revenue after 5 years of commercial launch. But why now? And why haven't port manufacturers done this? Port manufacturers see their device as a delivery tool, chemo in, blood out. And we've reimagined the port as a passive data collection and testing device. We compete against wearables, which have very low levels of patient adherence and engagement. And one other competitor only measures vitals, and we capture those measures as well. Our novel features create an actionable data package by measuring blood counts and heart function in the body. We have a line of sight to our market and commercialization. We've submitted several patent applications, confirmed our FDA strategy for a 510(k) for the hardware and the software, and verified CPT codes for reimbursement. We have early traction. We're in a second year of a collaboration agreement with Mayo Clinic, and we've received investment from Baxter, mHub, and Edward Elmhurst Ventures in Chicago. Our go-to-market strategy focuses on licensing the technology to port manufacturers, and we anticipate commercial launch in 2026. We're in the midst of a seed round of funding where we're raising $2 million for product testing and continuing to build out our IP. Our team has decades of experience in medical device, research, and business. Our board is also industry leaders in medical device, regulatory, and patient advocacy. I like to think that if NextGen Port had been available when cancer came to my house, my dad would be here today.
Kathy, that was a well-rehearsed pitch. Thank you so much for that.
Thank you.
Okay, and you ended just right on, like literally the right second. Impressive. All right, Sarah, let's go to you first.
Thank you, Kathy, for sharing and for your story as well. As exactly as you said, my mother-in-law passed away last year and had a port as well from cancer. So your stories resonate very much with our recent experience. I wanted to pick up, you were talking about the entrenched interests today. And so port manufacturers are just interested in chemo in, blood out, as you described it. So after you commercialize or you actually have the device up and running, how do you plan to disrupt those interests to actually create the wedge of who cares to bring this to market to the patients?
Yeah, I appreciate that question. So I should be more clear. They've done very little innovation up to this point, but we're being courted by a port manufacturer right now who understands the value that for them to hold market share, they've got to start collecting patient data. So we've already made inroads into strategic collaborations, of course, the work with Mayo Clinic, the investment from Baxter, and some of those other entities. We're resonating very strongly in that field. And so we'll have to have a come to Jesus moment where we decide to either be a strategic collaborator or forge ahead on our own and develop our own manufacturing and sales and distribution.
A big pain point in healthcare is there's so much data, there's more and more data every day being collected, but there is such a disconnect with the different care providers and the overall care continuum.
Yes.
And so how are you thinking about the incredible pieces of information that the port will be able to provide, making it to the right physician and being an actionable piece of data that the provider and the patient can work with?
That's such a good question. And we think long and hard about that. And we speak weekly with a physician from Mayo Clinic, and it's absolutely our favorite call of every week. And we're looking at, on our side of the house, we analyze this longitudinal data between chemotherapy visits where we're pulling data 4 times a day that physicians have never seen before, but they're still humans and they still want that one actionable data point to come through the electronic medical record that they see, resonate, and they can make a decision about. So we're going to be owning that analysis of the longitudinal data, still interact with the physicians, giving them a concrete data point, a no go on chemotherapy or growth factor, or blood transfusion or rescheduling chemo. So we know doctors are human too, and we're going to be catering to their workflow.
I'd love to hear more about how you think about the IP in the business. So to what extent does it start with the device itself versus the analytics on top and the data, and then the actual process that you're using to implement the data and the advice?
Great question. I'm very proud to say that NextGen Port holds all of our own IP, and we've filed 2 patents to date. The first one focuses on using optical sensors in the hardware. So we're taking port technology, optical sensor technology, miniaturizing it, customizing it, and this is my favorite part. I get to show you in the body of the port itself. And so the second patent we filed is on use case. So cancer, cardiac, renal, pediatrics, pharmaceutical manufacturers with virtual clinical trials, animals that are used for research, and animals that are suffering from cancer.
As you are thinking about your go-to-market, are you targeting any specific like therapy points or patient indications or types of cancer initially? And then how do you think about expanding that to all cancer patients or even beyond that?
So there are cancers that are going to be more adept and more find value in the smart port, for example, blood cancers, and then any cancer that a chemo port is indicated. And we're also thinking about cancer treatment that's an oral agent, but is so high risk that an implanted port that's monitoring a patient remotely would be of value. So, and please ask me that second part of your question again.
And how are you thinking about sort of expansion outside of potentially like cancer patients as well?
So we see opportunities to leverage our optical sensor technology and other catheters, whether they're IV lines, PICC lines, in diabetes care or in cardiac care. But we're starting with cancer because that's my story, my business partner, our chief technology officer. That's what resonates with us. So we're staying focused. And then, yes, we see significant opportunities to bring our technology to passively collect data for patients remotely, which is really the next generation of care.
I love your enthusiasm, Kathy. It's very infectious in
Thank
a good
you.
way.
Thank you.
Not in a bad cancer way. Yeah. All right. Well, thank you so much for coming on, Kathy. It was a pleasure to meet you. And
Thank you.
to Jordan and Daniel, thank you again. So what we're going to do now is we're going to cut the stream here in a moment. And the judges and I are going to discuss the companies. We're going to take a look at them and judge them based on potential for impact, either financially or socially, and come up with a winner. In about a half an hour, I'll publish on Twitter and TechCrunch the winner of that, and the winner will get exhibition space and tickets to TechCrunch Disrupt in October. It's the best gift I can give them. I guess merchandise would be good too, but I don't have any merchandise. So with that being said, thank you so much for everything today. This last 2 hours has been a great deep dive on Minneapolis. It's a fantastic city. I would highly recommend it. So with that being said, thank you so much, and we'll see you next week.